Ever wondered how the pandemic reshaped the commercial real estate landscape in Florida? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. Florida has been experiencing a commercial real estate boom, largely driven by financial and technology executives relocating to the state since the pandemic. This trend has been particularly evident in South Florida, where retail vacancies in areas like West Palm Beach are virtually non-existent this year. According to Ken Himmel, president of Related Ross, this demand is due to the steady migration of high-net-worth individuals and executives to South Florida since the early days of the coronavirus pandemic. With nearly 90,000 new residents added to Palm Beach County over the past few years, the city has transformed from a seasonal resort town into a year-round city. This rapid evolution has been strategic, fueled by Florida's dynamic economy, growing population, and favorable tax environment, making commercial real estate investment in the Sunshine State highly profitable. Steinbauer Associates Inc., a commercial and industrial real estate brokerage, highlights these factors as key drivers for the state's real estate market growth. City Place in West Palm Beach is expanding by over 125,000 square feet, welcoming new retail brands like Equinox, Alo, Reformation, and high-end makeup retailers such as Blue Mercury. Home retail shops like Crate & Barrel are also setting up shop. As investment firms and institutions open offices nearby, they bring a well-compensated population seeking elevated lifestyle experiences. This demand is met by integrated mixed-use developments like City Place, which combines office, residential, and commercial spaces in a highly walkable district, pushing vacancy rates below 3%. Even as new square footage becomes available. Developers are working rapidly to meet this demand. As financial services and innovation hubs establish roots in the city, retail rises in parallel, fueling a self-sustaining cycle of growth. This cycle continues to accelerate, as noted by Himmel. Kelly Lyles of KL International Realty also observes an uptick in retailers relocating to Florida, with companies like Foot Locker moving from New York City to St. Petersburg. Florida's diverse and growing population, coupled with its low taxes and lower cost of living, continues to attract both consumers and retailers. Companies with a significant presence in Florida are expanding their footprint, as exemplified by Publix's plan to open a new 50,000 square foot supermarket in Panama City Beach. In San Francisco, there's been a push to convert commercial spaces into residential units, a strategy originally laid out by then Mayor London Breed, and now expanded by Mayor Daniel Lurie. This approach aims to address the city's housing shortage by transforming existing structures, a process that has its challenges but isn't unheard of in the city's history. Several notable conversions have already taken place in San Francisco, such as the Royal Insurance Building, which became 46 condominiums, and the Old Chronicle Building, now a Ritz-Carlton residence. The largest conversion was at 100 Van Ness, formerly the AAA Building, which now houses 418 rental units. The architect involved explained that a significant change was replacing the old facade with floor-to-ceiling glass to maximize views, a project that began in 2013. However, developers are facing rising construction costs, which have increased faster than rents, making the financial feasibility of such conversions challenging. For instance, Mark Babson of the Emerald Fund noted that the cost of buying the same building today would be 70% higher than in 2013, complicating the economic viability of these projects. To incentivize developers, San Francisco has expedited the permitting process and reduced planning fees. Additionally, developers converting buildings are exempt from certain fees and affordable housing requirements, a policy started under Breed's administration. Mayor Lurie has introduced further incentives, like reimbursing yearly tax increases, to encourage more conversions. The city's efforts are optimistic, with officials like Supervisor Danny Sauter estimating that 50 buildings are potential candidates for conversion, potentially adding over 10,000 new residents to the downtown area. Despite these incentives, many developers remain cautious as they navigate economic uncertainties such as interest rates and tariffs, which could impact the success of these projects. Jared Schlosser has been elevated to lead originations in the Commercial Property Assessed Clean Energy, or CPACE, program at Peachtree Group, marking a significant development in the commercial real estate and hospitality finance sectors in the United States. This move reflects Peachtree Group's commitment to shaping the future of hospitality development and sustainable property investment across American markets. Schlosser's dual leadership role highlights Peachtree's focus on aggressive lending growth paired with sustainability, especially as developers and investors face stricter environmental standards and shifting market demands. In 2024, Peachtree originated $1.6 billion in hotel and commercial real estate loans, ranking seventh among investor-driven lenders nationwide, according to the Mortgage Bankers Association. The firm aims to surpass $2 billion in originations in 2025, driven by market opportunities and strategic leadership. The C-PACE program, which Schlosser continues to lead, is crucial as it allows property owners to fund energy-efficient improvements, renewable energy projects, and resilience upgrades through long-term low-cost financing repaid via property tax assessments. This model is increasingly attractive for hotel developers who need to meet environmental goals without compromising financial feasibility. The hospitality sector remains a key area for Peachtree Group's lending portfolio, with demand surging post-pandemic due to leisure travelers, business events, and a rebound in global tourism. Despite challenges such as rising construction costs and labor shortages, sustainable building practices and energy efficiency are now central to securing financing and guest loyalty. Schlosser's promotion is a testament to Peachtree Group's commitment to addressing these challenges head-on. His expertise in navigating complex lending deals and understanding sustainable finance tools positions him to lead the next wave of originations. Peachtree's strong loan originations indicate continued confidence in commercial real estate fundamentals, even amid economic challenges. As developers push forward with hotel renovations, new builds, and mixed-use projects across markets like New York, Miami, Dallas, and Los Angeles, Peachtree Group is well-positioned to capture this momentum. Schlosser's leadership will help structure deals that balance risk and opportunity, with C-PACE lending playing a critical role in making these projects viable. The travel industry is increasingly tied to sustainability, with guests and corporate clients demanding eco-friendly accommodations. Schlosser's dual focus on originations and C-PACE ensures Peachtree can offer solutions that meet both financial and environmental objectives. Peachtree Group's track record as a trusted partner for developers navigating complex environments, coupled with its agility in structuring innovative financing, gives it a competitive edge. As Schlosser takes on his expanded responsibilities, the firm's goal to exceed $2 billion in originations by the end of 2025 reflects a strategic bet on the resilience of the U.S. commercial real estate and hospitality sectors. In Bonita Springs, Florida, the upscale indoor golf and social club, Sanctuary Golf and Social Club, has signed a lease for the former Big Lots space at the Prado at Spring Creek Shopping Center. This marks the club's first location in Florida, expanding from its Nashville roots. The 28,000 square foot space will undergo renovations this summer, with plans to open later this year. Colliers, the real estate firm representing Sanctuary, announced the lease. The club will offer 9 golf suites equipped with simulators featuring 400 courses, 4 pickleball courts, and an upscale bar and restaurant. Memberships start at $199 per month, with a $1,497 initiation fee for individuals under 28, while family memberships top out at $399 per month with a $4,997 initiation fee. Meanwhile, in Naples, Florida, a fully leased warehouse in the Railhead Industrial Park has been sold to Redfern Capital, a Delray Beach private equity real estate firm, for $2.5 million. The 15,428 square foot warehouse features 11 drive-in doors and 18-foot clear heights and is leased to 8 tenants. Redfern Capital, founded in 2014, manages $770 million in assets with more than 250 active tenants across 3 states. The sale was brokered by Marcus & Millichap, with Zach Levine and Douglas Mandel representing Redfern. In Bonita Springs, the Hyatt Regency Coconut Point Resort and Spa is set to begin a multi-million-dollar renovation in mid-July, focusing on enhancing its meeting and event spaces. The renovation will include new carpeting, wall coverings, artwork, and updated lighting fixtures, with a mesh chandelier reminiscent of a conch shell in the Estero Ballroom. The Calusa Ballroom Terrace will receive new pavers, lighting upgrades, and redesigned landscaping. This project is part of a series of upgrades, including previous enhancements to rooms, restaurants, and the water park. The renovation is expected to be completed by fall. In Tampa, the Point at Carrollwood apartment complex has been sold to Miami-based Beacon Real Estate Group for $51.5 million. The complex is 95% occupied and consists of 224 units. Beacon Real Estate Group has refinanced the property with a 5-year, $29.93 million loan through Freddie Mac and obtained an $8.42 million equity investment from Atlantic Pacific Co. The funds will be used to pay off a previous acquisition loan and for upgrades. Beacon Real Estate Group, founded in 1967, manages over 7,000 apartment units and 1 million square feet of office and retail properties across the Southeast. Let's shift our focus to San Antonio, Texas, where a new $3.4 million shopping center is generating a lot of buzz. The development, known as Delphi at Potranco, is planned for Potranco Road, one of the busiest roads in Texas. This area is rapidly growing, and residents are eager to see what businesses will move into the new retail hub. The two-story plaza is being built about 10 minutes from the Redbird Ranch and Ladera neighborhoods, which have noticed an uptick in construction activity. According to the Texas Department of Licensing and Regulation, the retail center will be located at 14,617 Potranco Road. Dominion Advisory Group, the real estate entity overseeing the project, aims to include restaurants, a retail shop, and a medical practice in the area. VV Orthodontics, a Texas-based company, is already confirmed to anchor the entire second story of the building. This will be their third location in San Antonio, adding to their existing Northside locations. The project has attracted about $3.5 million in investment and will span approximately 13,000 square feet, including a business with a drive-through. Rashid Khalif, a senior leasing consultant for the site, noted that the food and beverage lineup is still being finalized. The goal is to include a drive-through that caters to families, especially given the presence of schools and apartments nearby. This strategic location is expected to serve the needs of those commuting to pick up children or heading home from work. The retail center's prime location off Potranco Road and State Highway 211 makes it accessible to nearby towns like Castroville and Lacoste. It's also close to Stevens Ranch, a rapidly growing community in San Antonio. Dominion Advisory Group is actively researching this corridor due to the consistent growth of local neighborhoods and businesses. Marketing materials indicate that roughly 55,000 people live within a 10-minute drive of the site, with over 16,000 households in the area. Potranco Road saw over 28,000 vehicles pass by the future retail hub daily in 2022. Construction on the plaza is expected to finish in the second quarter of 2026, with the opening date anticipated for the same period. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.